As we're just bringing up the PowerPoint, I have to wake myself up from that startup music. So it was lulling me to sleep a little bit. Welcome, everybody. Thanks for joining us today for the 2025 US forecast from HVS. Some thoughts that we pulled together that we thought you might find useful as you are launching your year, looking at the industry, looking at deals. We want to arm you with our thoughts and some good data and insights as you do so. Um, I want to thank you for all the questions that you've provided to date. Those have been great. They've helped form some of the content during the presentation. Hopefully, you'll get some of those questions answered. If not, any question that you did submit, I'll be sure to reply to you sometime over the course of the next week. Just give me a little bit of time to get to those. You'll get a personal email from me. Also, any question that you might have as the presentation is progressing today, feel free to drop it into the chat box. We will take note of those questions, and I will also get back to you post presentation with an email and a response, and we'll make sure to take care of those. Just a quick preview of what I'll be presenting today. We're going to be looking at our forecast of occupancy and ADR in the coming years and some of the driving factors behind those numbers, where cap rates are now, where they're likely headed, followed by current valuation trends, discount rates, exit cap rates, where GOP and NOI is or should be, and important factors on those fronts too. Later on in the session, I'll invite Eric Guerrero to join me to talk transactions. He leads our brokerage division, followed by Emil Iskandar will join in and we'll talk financing and how the mortgage market is looking on that front. So let's get started. Don't hit the snooze button. You might think you should after you see some of our initial metrics and forecasts for occupancy and rate, but definitely not the year to do that. Before I show you where we think occupancy and ADR are headed, just want to chat a little bit first about some of the underlying assumptions and things to think about as we dive into this content. No major leaps, as you'll see in a moment, are expected with occupancy and rate, and also no huge changes are going to be expected with cap rates and investment parameters, but we nevertheless want to go through those with you and show you the direction of change, where we're at, where we're headed. It's important to know that for the industry. The biggest driver, I think, to keep in mind is the change in sentiment that we're experiencing this year and in 2025 that will lead us to heightened transactions this year. There were many unknowns in 2024, and as we head into 2025, there's certainly a lot of noise on the media about changes that are afoot and things that are happening. But when you peel away that noise and you really look at what is now behind us in 2024 and what we have ahead of us, there's a sense of understanding that we know where we're at more than we did a year ago. And that sense of knowing where we're at and the positive outlook that we have for the industry, drawn together by positive outlooks across so many markets in the US, is really going to drive strong transaction activity this year. Keep in mind that in 2024, there was more uncertainty regarding recessions, regarding the economy. And as we head into 2025, there's a sense that we have a greater certainty of what might be coming down the road. The Wall Street Journal just published a survey of top economists, just hot off the press. 50 or 60 economists opined in the survey. And one of their metrics was what's the percentage likelihood of a recession in the coming year? And that percentage continues to decline survey after survey. And we're at a point now where the percentage is similar or getting very close to where we were when the market was at its last peak in 2021. And it's about 2/3 of the sentiment when it was at its worst point in the latter quarter of 2022. So that's a very good sign as we head into this year. There's a sense that there's a low probability of recession this year, and that things should be steady as she goes. And steady as she goes leads to a strong transactions market. Other thing to keep in mind is that we've got unemployment in the survey is expected to hover around just above 4.4%, and inflation is expected to hover near 2.5 and not get down to that 2% mark that the Fed always hopes for, but low enough that the Fed may push through a little bit of further discounting this year, although we expect interest rates to remain relatively stable throughout the year. But that stability drives deals, and so we're looking forward to that. So not a year to hit the snooze button. We'll go on and look at our forecast next. Okay, perfect. Occupancy. You can see that there's not a big change here. We're expecting an occupancy that's close to 63%, which was where we landed in 2024. Anywhere between 63 and 63 and a half is likely where it's going to land. We put the dot closer to the 63, and we'll see how the year plays out. It's important to keep in mind that this doesn't mean that demand growth is necessarily flat. Demand growth will be quite favorable. We expect close to just over that 1% mark in demand growth. What's keeping occupancy flat or close to flat is the fact that we have increasing new supply that's coming out of the gate. And we'll look at new supply, what that looks like here in a moment. But that's gaining steam, so that's going to help it'll temper occupancy overall. But positive room nights are moving in a positive direction, which is great. ADR, we expect to move up by 2% this year, followed by 2.5% next year and 3% the following. Some strong market fundamentals and demand fundamentals are going to drive that. So that's great to see. We're going to talk about some of what those positive factors are here in just a minute, so you can understand why rates would be moving up and why demand would be moving up as we expect it to. So what I thought we'd do next is take a look at some key markets. The forecast of occupancy and rate for the nation is drawn from a wide swath of so many markets across the US, and each of those markets really operates and moves independently from one another and has its own sense of direction, own impacts of new supply, own demand generators, and each one being distinct from the other. So I thought it would be interesting to look at a few key markets and what we're seeing there. In New York City, for example, we're seeing some strong RevPAR growth. A comp set that we recently worked on had 7% RevPAR growth last year, which is notably bigger, more significant than the nation as a whole. That market has seen great comeback in recent years, and recent law change with Airbnb caused a significant reduction in those listings, which then also boosted the hotel industry. But high tourism, strong midday transient coming back, very strong market, and I expect 2025 to be another strong year. San Francisco Bay Area has had not as robust of a recovery as many of us do know, but coming from a lower basis point and seeing a recovery yet in the future over the next few years is in the cards. And with that kind of a recovery, we'll certainly see higher than that 2%, 2 to 2.25% RevPAR growth across those markets in the coming years, which will further boost the national average. Atlanta is coming off a very strong year, strong convention cycle. The Signia opened there in downtown in late 2023 to further support convention growth. This year may be a little bit of an off year for conventions, but continued progress of returning to office and uptick in transient demand and in-house booked grouped business will certainly continue to drive recovery in that market. And RevPAR growth, that is fairly strong. And Maui is another good example of its recovery post-fire impacts, and coming from a lower basis point over the course of the next few years, as it bounces back from that impact, we'll see some pretty strong RevPAR growth. Seattle's a good example of what is happening with return to office and how it is impacting hotels. And what we're seeing there is I think a good case study of what we'll see in other major metros across, or what we are seeing in other major metros across the city, with more and more companies asking employees to come back to the office. With that comes increasing needs for requirements for hotel rooms. And those major companies have gone out to the hotels in downtown Seattle asking for greater commitments, new negotiated rates. And it's a very favorable story there in Seattle, and as I said, in many similar markets across the country. And so that's great. Seattle also has a strong uh, tour, cruise industry going for it that's been very strong in recent years. So a nice recovery headed there. Vegas and also Salt Lake City continue to show some strong rebound of group business. Of course, Vegas to on a greater scale, but that will really help. And then finally, LA is seeing a short-term boost um, from some fire-related impact. But just a couple of questions that were asked by you earlier. What's the outlook for urban full-service hotels in 2025 and 2026? We see the outlook favorable. Demand is coming back strong, and as more and more folks return to the office, which is seemingly the trend, and convention business and group business coming back, we see a favorable outlook there. That's certainly going to allow those submarkets to rise above the national trend of RevPAR growth. Having people return to the office does translate to additional hotel room night demand, and we're seeing that in case by case, and in the submarkets that we're working on, companies are asking for and producing greater amounts of room nights. So that's great to see. Quickly, the ADR in our industry, as you know, can really move up through the ups as market demand improves. Hotels are able to make quicker changes to essentially their rental rate, which is ADR, than other types of property can. There's still corporate negotiated rates that can't necessarily be changed, or groups that have been booked in advance, then those rates can't necessarily be changed. But there are other aspects of the business that can be. So leaning into rate management systems is important at this point in the cycle. And looking ahead to any special events that are in your market are important. Offering promotions on extended stays, and then also incentivizing your staff to achieve upgrades are key at this point. Just a quick look at the sharing economy. One thing is for sure is that nothing is the same across the country. Every submarket, every municipality has its own policy, but they're all seeking to open housing back up so that it's easier for residents to find a place to live versus having residences taken off inventory, so to speak, and pushed into Airbnb. So this in turn is helping our industry, because as those rooms come offline on Airbnb, people are having to seek accommodations back in hotels. We're seeing this as a big plus in New York City, for example, with a 92% reported drop in Airbnb listings following their 2023 law. We're seeing some strong, some significant regulations coming out of markets like San Francisco and Honolulu. And those markets have really limited the number of days that can be rented to short-term rentals or even rented at all. Santa Monica and Denver have instituted laws where you can only share on those platforms if it's within your primary residence. And in Seattle, an example of a market where you have to have you can only have one additional listing as long as you have your current primary residence in the city. So all sorts of different regulations out there, but all really benefiting our industry. As I mentioned, supply growth has remained muted. Over the last couple of years, it's been half a percentage point over those years. We're looking at some more growth over the next few years, certainly above those last couple of years benchmarks. So I do expect demand growth to keep pace with that, and keep in mind that the percentage of supply growth also takes into consideration rooms coming offline. So that helps balance things a bit. So the actual percentage of new rooms coming online may be above that 1%, but rooms coming offline will help temper that a bit and make it a bit less of a blow to the industry. All right, talking about cap rates next. Wanted to take a look at where transactions are being reported with their cap rates. You'll see here that things are converging on that 8. We've got the limited service line there at 8.3 and the full service line at 8. But there's a but here. I just want you to keep in mind that this is for transactions that have closed and also transactions where a cap rate was reported. So it is somewhat limited of data. It's still good data and it's a good benchmark, but it is limited. So for the 8.3 on limited service cap rates for the valuation work that I'm doing at this time with our major lenders across the country, we are seeing going in cap rates based on year one forecast in that 8 to 8.5 point range for limited service hotels. So that is where things are at right now. We would normally expect to see cap rates perhaps a little bit higher than that, but what we're seeing is that we're seeing more deal flow with stronger hotels, stronger performing hotels. And when that happens, those are the hotels that are going to bring more offers to the table, have better pricing, and ultimately drive that lower cap rate. Other things to keep in mind too with that is that most of these hotels are requiring a rather significant PIP. And so the PIP is going to be driving some post-PIP uplift in NOI. And oftentimes a buyer will expect that uplift in NOI to be rather significant. And that increase in expectation will drive a strong price. But when you compare that to T12 or year one NOI, maybe a little bit depressed pre-renovation, that can drive the lower cap rate. On the full service side, though, being at 8%, that is a little bit of a misleading number because there have not been that many full service hotel transactions. So really the market right now for full service cap rates is closer to 7 to 7.5. And so bear that in mind if you're looking at a deal and looking at a full service hotel. You're going to be about 375 basis points roughly below that, a little bit more, maybe a little bit less. So on the select service side, which is not reflected here, that too is in the 7 to 7.5 mark for cap rate because of there's heightened interest for select service hotels, and so those cap rates tend to be in that same range of 7 to 7.5 that full service is. All right, so there are factors that are going to drive your cap rates below that 7 to 7.5 or 8, whatever category you're in terms of average. And so just a quick look at what some of those reasons are that you might ultimately be looking at a deal that might be below that 7.5 mark. Recent renovations that can impact things because you may have had a property that was going through a renovation in the T12 or is going to be going through a renovation in year one. That's going to depress NOI and therefore lead to a lower cap rate. You could have a market that's coming out of the recovery late and it's coming into a robust period, a period of strong cash flow that will ultimately drive a lower cap rate. The hotel could have been undermanaged, and a new buyer is going to come in and properly run the hotel, perhaps, and achieve a much stronger GOP and bottom line. That will drive a lower cap rate. And finally, there are key gateway markets that do ultimately, by virtue of price and what people are willing to pay for assets in those markets, they tend to apply lower cap rates simply because they're willing to accept lower returns. Okay, cap rates may veer above the 8% mark too. These are important things to think about. Forthcoming renovation could have an impact on operations in the coming years, and you can just, yep, current operator. This is an important one. You could have an operator that has an operation that's too efficient. They've figured out practices that are abnormal to the market and not sustainable. So those have to be accounted for. So make sure you look at that. Also, they could be sharing expenses across multiple properties, and that too, then once you account for those additional expenses, can cause a higher cap rate once you adjust out for that. And then finally, you could have an asset in a market that is just not as desirable. And so you have fewer buyers not willing to pay as high of prices, and that drives cap rates to go above the 8. So you can go ahead, let's go ahead and just push those through for me. Overall cap rates we expect to come down a bit in 2025. We're going to have more buyers in the market. That's going to drive a little bit less need for discounting and provide some higher pricing and some higher and with that comes a slightly lower cap rates. Some of that transaction activity that's going to be coming through is due to some more PIPs now that are required. Current owner may not want to deal with that, may want to punt that to the next owner, and that next owner may be seeing that upside post renovation that's going to drive the lower cap rate. Stability in an interest rate environment will support higher transaction volume. We'll talk about that a little bit later today. And also overall stable market fundamentals that I touched on at the very beginning of the presentation today with economic factors looking to be relatively stable over the course of this year will set the stage for more buyers and sellers coming off the sidelines to get deals done when they feel like they have a sense of what's going on. All right, next I want to just talk about modeling a smart DCF. Perfect. So discount rates. We see discount rates now gravitating towards 10. Let's see here, give me just 1 second to get to a couple more of my notes. Here we go. Gravitating towards a 10 right now. I want to talk a little bit about discount rates with you. You can see that the luxury and upper upscale line is below, appropriately below the other lines. They drive their deals drive lower discount rates. We expect that dynamic to hold true this year, but instead of having that line at that 10 mark, we'd expect that to come down by about 50 basis points, closer to the 9 to 9.5 range. And similarly, that goes with the lines above. We expect discount rates to trend from that 10 to an 11% mark down to the 9.5 and 10.5. And then with exit cap rates similarly going from 9 to 8 to 9.5 to 7.5 to 9. But stay on this slide for just a moment. And for our limited service discount rates, I just wanted to break these up a little bit more because even though we're looking at 9.5 to 10.5 as a whole for the lodging sector, for limited service, we're expecting in 2024, we saw discount rates being 10.5 to 11. So now we're going to have those tick down. By the end of the year, we would expect to see discount rates perhaps closer to the 10 to 10.5 mark. For select service hotels, so we're looking at within this range of the 9.5 to 10.5. Towards the high end of that range is going to be our limited service stock and our limited service sector. Select service will be in that 10 to 10.5 range. Was in the 10 to 10.5 range, and now we'd expect that to come down to the 9.5 to 10 range. And our full service hotels, which were previously in that 9.5 to 10.5 or 9.5 to 10, will be coming down to closer to that 9 to 10 or 9 to 9.5 position. On the exit cap rate side, in 2024, limited service was at that 9 to 9.5. Select was at 8 to 8.5, and full service was at that 7.5 to 8. Going forward into this year, we'd expect those to come down similarly by 50 basis points. So that's our forecast and our expectation for discounts and exit caps. All right, I just want to take you through a quick example on creating value with underperforming assets. And so these circles here show where a property should be, all things being equal, should be landing for GOP. And so if you've got an asset that's wildly above or below, that's something to look at. There will be good reasons why an asset should fall outside of these ranges, but oftentimes there aren't good reasons. They're just being mismanaged or something funky is going on at the asset. So something to consider. These are important ranges to consider. Full service at 35 to 40, select at 40 to 45, limited service at 45 to 50, and extended stay at 50 to 55. This is GOP before you deduct your fixed expenses. And if we look at a scenario just for where value creation can happen, I'm going to give you just a quick example of a limited service hotel. Say it's at 60% occupancy, $120 ADR, and a $30,000 PIP is right around the corner. It's currently being operated at a 35% GOP. And as you can see from my dot up above, perhaps it should be being operated at 45 to 50, but the current management company is just unable to pull that off. Now might be the time for the owners to make a change. And when they're going through the renovation, maybe they also install a new management company. And so during that time, renovation, perhaps the hotel perhaps closes or scales down its operations significantly, goes through that big transformation and change, and comes out of the gate with a new vision, perhaps a new comp set, a new gauge, and a new management company is able to get it up to 67% by stabilization and a deflated rate of 140 instead of the 120. So that's the kind of change, the potential that might exist for the property. The new company is also able to get that GOP up to that 45% where it should be, rather than stagnating at 35% or so, with certainly the potential to go higher than that. How does this translate to value? Let me just show you on the next slide. Pre-renovation, those are those metrics that I noted previously. That's what gets you to the NOI of just over 700,000. Playing it safe with your current management company, let's say they're able to get that rate up to 130 and the occupancy up to 65, but the GOP is only able to go maybe up to 37 instead of 45 where it should be, and maybe that ADR isn't quite where it should be either. Applying an 8.5 cap to that, you result at a $7.7 million value. But if you take the brave change and you embrace value, you embrace the full potential of what your asset is and could be, perhaps you can get that occupancy up to 67 instead of 65, ADR to 140 instead of 130, your GOP up to that 45 where it should be, and applying that same cap rate, you are up at a $12.3 million value, and certainly a value per key at a 123 in this example, which just sounds a little bit more normal for an asset performing at these levels. So big changes here. And so it's important to really look at who's managing your property. Are they doing a good job? Are the metrics where they should be? And are you extracting the value and income out of your property that you deserve? It's important at this point in the cycle when we're in a steady year. Now's the time to maybe look at these things and start to make changes. All right. As you can see, I used that $30,000 benchmark for a cap deduct in that example. That is not high. That is the world that we're living in right now. It costs a chunk to get these hotels renovated. Oftentimes, you're having to go down to the studs in the bathrooms and install all new fixtures. In public areas, you're having to move some walls, and the costs can be rather significant. On Fairfields, we're looking at 25 to 40 a key, and you can just show us the rest of the brands if you don't mind. All the way up to 60 a key on Hyatt places. Some of the older Hyatt places are requiring some pretty significant exterior redos. Whenever you layer on an exterior redo or any kind of a facade change, it of course increases your overall PIP to the tune of, over $1 million adding on just to redo an exterior, if not more. So those are important things to think about if you're looking at any kind of exterior work, any kind of major interior work, moving walls, setting reconfigurations, having to convert tubs to showers, that type of thing. The renovation costs can be pricey, and if you're looking at full service, then it's going to be even more than this. All right. Awesome. Eric, welcome today. I have to take a breath. It's good to see you. We want
Thanks,
to talk
Brett.
transactions. Um, and so what we're going to look at, just give me a second here. Bear with me. While I do this, did you see just in your random life during 2024, and not at a concert or not at a sport event, an athletic event, just in your random world, did you come across anybody famous?
No, I did not.
Not even in an airport or in a shopping mall?
Semi-famous, Jose Altuve. I saw him in person in Houston.
Okay, I don't know who that is.
He's a baseball player.
Okay,
He's kind of a big deal in Houston, but
all right.
nationally, not a lot of people know him.
So just a quick story. I won't spend more than 2 minutes on this, but we were at the Walton Street Hotel, I think it was in New York. And I live in Colorado most of the time, and we see no famous people there. And we were at that property, which was an extraordinary hotel if you haven't been there. And we ran into Serena Williams, and that was a moment. So I love running into famous people. For those
Yeah.
of you that don't know that, it's one of the greatest things when I'm running around looking at all these hotels, and I looked at so many in 2024. I'm always on the lookout for who might be lurking in the lobby, that I can have a moment with. We had an interesting moment with Serena. But anyway,
And you saw her without her entourage, right?
if any of you on the call have run into anybody famous in your travels in a hotel, even better, please add it to the chat box during the course of the next few minutes. I would love to see who we're running into out there in the world. But anyway, back on task here. Let's talk transactions, transaction
Yeah.
activity. 2023 and 2024 have been awfully unexciting when it comes to transactions. Um, tell us about what you experienced in 2024. What were the factors that kind of made this happen?
Yeah, so I think the market was dislocated in general. What we saw were there were more sellers than buyers. And I think that was driven primarily by the rise in interest rates and then the pending election. And it was really hard for a buyer to underwrite with certainty. So as a result of that, there was just less buyer competition, less offers on properties. So most sellers that were selling their assets weren't meeting expectations pricing wise. Depending on the hotel, depending on the location, Bids were coming in at maybe 5 to 15% of what the sellers wanted.
Yeah.
And because of that, most owners, weren't selling unless they had to. So the motivated sellers drove the market. So those were ownership groups that had to sell for various reasons, whether that was a maturing loan, a fund maturity, a PIP issue, a partnership issue. We did not see as many opportunistic sellers bring their properties to the market. And you alluded to this earlier, but the smaller, the sub $25 million assets did not see a significant decrease in volume. That was still relatively strong. It was the over $50 million portfolio sales or single asset sales. You just didn't see a lot of those. And on the deals that we worked on, the financing was really, kind of the big issue. And Emil will talk about this in a little bit, but comparing the deals that we closed last year versus 2 years ago on the financing side, there are larger equity checks, there's personal guarantees, and there's fewer lenders out in the market willing to finance hotels right now. And
Seeing
that's,
things. Yeah, go ahead.
yeah, and I was just going to say, lastly, the PIPs were a bigger issue in terms of the buyer perspective. The costs have just gone up, like the materials and the labor. So even more so than what the expectations were. So that's negatively impacted pricing a little bit as well.
Yeah, makes sense. What are you seeing and expecting for 2025?
So we've talked to a lot of ownership groups, both on the buy side and the sell side. Based on what we're seeing and just what our pipeline looks like, we're expecting about a 10 to 15% increase in deal volume across the board. And I think that's just driven by the two issues I told you earlier. Those are behind us. And now someone can underwrite with certainty. And I think buyers will naturally come back in the market. So there's going to be more competition on deals. And that should actually boost up pricing slightly. I think you'll see some more portfolio sales and some of the larger transactions, you'll start to see those trade. Anything that's extended stay, there's a ton of buyer demand. That's a very hot commodity. And then I'd say one trend that we're actually already starting to see right now, there's a lot of institutional ownership groups that have either like non-core hotels or non-performing assets for various operational issues. From a valuation perspective, the going in cap rate will look really low. But there's a segment of the buyer community that is the private ownership groups of the world. They can go in, they could maybe own or operate or reduce expenses to boost the cash flow. So their going forward cap rate is going to look better. So maybe they'll value it on a room revenue multiplier or price per key. So I think you'll see a lot of that happening this year.
Yeah, I've talked to a few of those buyers, and they're fascinating conversations. They go into assets with this view of like, where can I add a room or two or three, and what can I do with the restaurant, or where can I extract more revenue?
Yeah.
It's an exciting side to be on.
Yeah.
Cap rates in the coming year, what are you expecting? Yeah,
I'm expecting 8 to 9. And
yeah,
the same time last year, I was 8.5 to 9.5. So I
okay,
do think they're going to come down. And that's just a function of more buyers out in the market.
okay, great. And you'll be on the lookout for more famous people next year or this
I
year?
will be. Yeah.
Okay.
Yes.
Okay.
Yeah.
I'm going to ask you before the NYU conference during our next webinar, um,
Okay.
who you've seen between now and then.
Okay. I'll make it happen.
Okay, Emil, let's talk financing. But before we get to that, have you seen anybody?
I was thinking hard about that question, and I honestly said I can. Although I'm
Okay.
based here in Los Angeles, you would expect that I would bump into more, right? But I guess I've just been hanging out in the wrong part of town.
Sometimes you don't look at people in the face and realize that they're famous.
That
I
could
was working out last June. I was working out. This is at the St. Regis in New York City. I had never stayed there and I really wanted to stay there. It was during the NYU conference, and Seth Marks was working out in the gym
oh,
with me. And he is the husband of Meredith Marks on the Real Housewives of Salt Lake City.
right.
And I am a big Real Housewives fan. It's how I decompress. And so that was a great day when I got to meet Seth. So anyway, let's talk about why we're here. What are you seeing in the mortgage market? What did you see in 2024 with lending? What were some of those factors?
So yeah, thank you, Rod. I'm going to cover briefly what as far as 2024 as well as kind of share with you what I'm expecting for this year.
Right.
And I think along the line of the questions you had with Eric, I'll also will share kind of what I'm expecting. How deals are getting done for this year when it comes to financing. So 24, looking back, obviously transaction on the financing and refinancing side was lower. I can think of three primary reasons contributing to the trend. Number one, just the number of active lenders. We saw banks a lot more restrained in extending credits, especially to new customers. Pressures from the regulators, uncertainties in the economy, as well as the delinquent loans that are weighing down on their balance sheet. That's kind of holding them back from originating loans. Now, just to put things in perspective, in the US, commercial banks hold over 50% of all outstanding CRE loans, including hotels. So that's a big chunk of the money supply. Reason number two, just tougher underwriting standards. I mean, well, CMBS lenders were active last year, but their underwriting was very driven by rating agencies' requirements when it comes to debt yields, DSCRs, and LTVs. And lastly, as Eric alluded, high borrowing costs. It was definitely a huge factor. Although we saw investor-driven funds came in and tried to fill in the voids, but in a lot of cases, the rates that they're offering is somewhat cost prohibitive to make a deal pencil. So I think those are two, and I'm sure the audience and you and the audience have experienced one of these, one or two of these situations yourself. So looking into this year, I think there's a couple of things that I will note. I'm certainly hoping that transaction volume will pick up, will go up, and the two drivers that I can think of is number one, I expect construction lending to come back. They've been virtually absent last year. And just looking at our internal data where we track requests for proposals for appraisals and assignments, we have seen an uptick of requests or jobs coming in from commercial banks. And I think it's interesting for our audience to also note that these are for jobs involving smaller hotels, limited service, select service hotels in secondary or tertiary markets. So these are not just trophy properties in major metros, backed by national or institutional sponsors. So I think that's refreshing change to see. The second driver is also maturing loans. I think TREP reported about $544 billion of maturing loans last year, which including hotels, that some of them got extended to this year. And I think they're projecting about the same amount, about $533 billion for this year. Now, these extensions can only go on so many times, right? I mean, eventually lenders will need to exit, and I think borrowers will come up with creative ways and restructuring and repositioning their assets, for the next round of financing.
The slide here.
So, I mean, this is something that I wanted to also point out. I think of course, the question becomes, what about rates, right? So I expect rates to remain elevated this year, at least in the for now, until concerns over future inflation subsided. Now, the cuts that the Feds have implemented have benefited some borrowers, especially those borrowing short-term floating rate loans that are based on SOFR or LIBOR. I'm sorry, not LIBOR, SOFR or prime rate. We're past LIBOR time now. Now, I do expect, you know, things elevated because, as we all know, most hotel loans are priced over treasury yields that are not necessarily dictated by the Fed's decision, but rather the bond investors' sentiment. That being said, I think both sides of the trades will eventually adjust to this environment. And if I could just point you back to the charts that's shown here, this is basically a transaction volume going back a few cycles, and we overlaid the trend on treasury yields going back the same period. And specifically, if I just go to focus on the period of 2005 to 2007, where we saw about $161 billion of total volume, it is definitely far surpassing what we've seen in the last two peak cycles. I mean, keep in mind, rates were not far off back then, or very close to where we are right now.
Yeah, that's a great point. So the market can operate at a strong level, healthy level, even at this current rate position that we're at. Thank you. All right. That was a great overview. We've got a few questions that have come in. We're going to take time to just look at a couple of them, and we'll be sure to get back to you all with answers to all of the questions posed. And thank you for keep asking them as we go. Eric, I'll ask you one that was submitted. If you could elaborate on the difference between where you see current market values versus replacement costs.
Okay. Yeah, I think that depends on the hotel itself. So there's two buckets of assets being sold. There's the value add properties that are being sold at below replacement costs, and then which honestly is the majority of the deal flow right now. And then you have the stabilized or new construction assets that are being sold to a premium of replacement costs right now. So I think this year we're probably going to see a lot of below replacement costs deals trade, but there are still certain properties, certain locations where I think you will see a premium. And the other issue is the costs have gone up significantly. So that's part of the whole valuation issue.
Okay, great. Emil, one for you. By year end 2025, where do you expect interest rates to be for high quality, high performing hotel assets using 70% leverage?
If I have to pick a range, it would be high 6 to low 7. We just did a sampling of about 34 recent closing of single individual hotels, not portfolio financing, and in the last 30 days, and the average rates was about 7.1 to 7.2%. So to my point earlier, I do think, at least from the data that we have right now, will probably remain at that level and maybe just kind of drift slightly lower. But I think that's kind of where we end up the year, unless there's some major changes between now until the end of the year.
Okay, great. One more question for you, Emil. The 2025 outlook for construction loans, permanent loans, post-construction, refis upon stabilization.
I think I feel a lot more optimistic for this year. I mean, we're certainly, in my view, I think we're in a much more stable and predictable environment right now, which would lead to a more robust and active lending. So, as I mentioned in my previous comments, I do expect a return of construction lending, just basically based on anecdotal data that we've seen, just a flow of jobs coming in from banks ordering appraisals for new builds. So I think that's refreshing. We all miss in kind of the absence of construction lending last year. And of course, the rest of it, whether it's mini perm or permanent loan, will follow after that.
Okay, great. Well, thank you. Thank you both for helping me out today on this presentation. It's been great. I just wanted to offer some closing thoughts for our listeners before we close out today. A reminder that I will be getting back to you with your questions that you have We'll make sure to get answers out to you, and you'll have also get a copy of the recording. Um, the just as a recap, we've got cap rates on the move downward. Right now for closed transactions, we're at that 8 to 8.5 mark. But for full service, we're seeing cap rates certainly a chunk lower than that at that 7 to 7.5 mark, and expect those to even trend a little bit lower than that range in 2025, with limited service still staying in that 8 to 9 range, with the stronger properties at that 8 to 8.5 range going forward. I know cap rates are always a hot topic. Discount rates and exit cap rates, as you all heard too, are trending down slightly, perhaps by 25 to 50 basis points. And we went through some of the ranges for where the different property types are on discount rates and exit cap rates. And I hope that was helpful. And the transaction market is looking to be better in 2025, with the stability in some of the things that drive the market. That kind of a stable outlook really in turn supports an active lending and an active transaction environment. So looking forward to what's a busy year. Time will tell. We'll see if all of this comes true. We will do another session similar to this just before the NYU conference in mid-year. So we'll be able to look back and see how right we were. And so we'll be sure to do that and share some more insights. You will be getting a survey following this presentation to provide us with some feed forward about how this was for you, how we can perhaps improve it for the next time. Would love to hear from you if you have ideas or some feed forward for us. It's always helpful to hear from you, and we'll be sure to get back with your questions. Want to thank the folks behind the scenes for helping me put this all together. And again, Eric and Emil for joining me today, and all of you for listening. Thanks for joining me today. Hopefully this was helpful, and I wish you a successful Alice conference next week. If you're headed that way, should be a really great event. So thank you so much. Thanks, everybody.